Alex Chris is out, and PayPal has a new CEO. So HP chief Enrique Lores is going to serve as PayPal's new CEO. Alex Chris was really seen as the savior of PayPal. He took the reins from PayPal from outgoing CEO Dan Schulman in late 2023. He set out a technology-focused vision based around tools like AI and stablecoins. So just barely 2 years later, that vision has come up short, as PayPal on Tuesday has announced it was pushing out Chris in favor of board chairman Enrique Lores, who is currently the CEO of HP. Now, I know a lot of people for a long time have been bullish on PayPal. Friends that I know have been buying PayPal left and right, especially as Alex Chris took over and started leading the company in this new direction. So this is actually a big surprise to me that they let him go. PayPal is down today 20%. If we look over the past 5 days, PayPal is down 24.88%. So it was sliding down a little bit, and then this news made it just absolutely crater. Past month, PayPal is down 28%. If we look at the past year, down 53% over the past year. And over the past 5 years, PayPal is down a whopping 83.26%. So this is just a stock that's been devastated, and people have been buying it. Essentially, I know people that have been buying it since 2022, thinking it's bottomed. It looked like it had bottomed. It looked like it was recovering, and this news just adds insult to injury. So what we're going to do in this video is we're going to look at PayPal, and we're going to look at some of its competitors in the finance space. And yes, this is our first finance-focused video because we have adjusted our algorithm and we have adjusted our scoring method to now include financial stocks. So buckle up, it's going to be an interesting one. We're going to look at PayPal and four of its competitors to see, is this gigantic drop a buying opportunity, or is this just the falling knife? So we're going to start with some growth scores. We're going to look at American Express. American Express has some numbers that are going for it. It's got a forward PE at 18.7. That's some of the best that we'll see of these five companies. A free cash flow yield of 7.9%. Remember, we like to see that above 7%. So American Express has that going for it. And a forward PE, a 5-year forward PE coming in at 12 even. So that means that if you were to buy American Express today, you would be getting it at a 12 PE based on 5 years of growth. That's if they can grow 13.6% every single year for the next 5 years. MasterCard, now these numbers are just phenomenal. We see a return on equity of 210%, return on invested capital over 77%, profit margins coming in at 45.6%, revenue growth at 11.3%, EPS growth 15.8%. So just phenomenal numbers for MasterCard. And then here's PayPal. Now PayPal, they have some of the growth metrics that we really like to see. We see that the PEG ratio is 0.8. Remember, we want that under 2 definitely, and if it's under 1, that is very attractive. Forward PE coming in at a 7.2. That is the best that we'll see of all 5 companies. Debt to equity ratio coming in at a 0.5. So their return on equity, return on invested capital, not the best, but not too terrible either. But we see a free cash flow yield at 14.4%. That is fantastic. And a 5-year forward PE coming in at 4.5% with just an 11.6% EPS growth. So that's very attractive. SOFI, also a big growth company. PEG ratio coming in at the lowest, just slightly under PayPal's at 0.7. Debt to equity ratio 0.2. SOFI has basically no debt. Revenue growth 13.8%. That's the highest that we'll see of these 5 companies. And EPS growth coming in at a 32%. So that's fantastic for SOFI. Finally, Visa. The one thing that we'll note is we couldn't find reliable revenue growth metrics and estimates based on analysts' expectations. But we see a 14% EPS growth every year for the next 5 years. And they have fantastic return on equity, return on invested capital, and the best profit margins of all these companies. Remember, on this channel, what we do is we score companies from -10 to +10, -10 being absolute garbage, +10 being phenomenal companies. And so at the very bottom, surprisingly, is SoFi coming in at a 2.8, MasterCard coming in at a 3.3, Visa coming in at a 3.9. Now, SoFi, like I said, that's the surprising one because this is a growth company. We see that they're going to grow EPS 32% every year for the next 5 years. At least that's what analysts expect. They have very low debt to equity, and they have a fantastic PEG ratio. The problem is the return on equity and the return on invested capital is holding SoFi back in these metrics. And so the more mature companies of Visa and MasterCard, not too surprisingly, are coming in with relatively low growth scores. But we see the top 2 are American Express, and at the top of the leaderboard is PayPal. PayPal has the best growth metrics of all of these companies collectively when we run it through our valuation model. we see that the PEG ratio, the forward PE, the debt to equity, and the very low 5-year forward PE is putting PayPal at the top of our growth scores. Now we do the same for safety. The big thing for safety is dividends, dividend growth, and sustainability of that dividend growth. So American Express comes in with a PE ratio of 22.7, dividend yield at 1.1%. They've grown their dividends about 17.1% in the recent years, and they've grown their dividends for 4 years consecutively. Payout ratio coming in at 21.3%. That's fantastic, not too high, not too low. MasterCard payout ratio at 19%. They have grown their dividends for 14 consecutive years, dividend growth at around 15% clip, so that's fantastic, way outpacing inflation. Now, PayPal is actually paying a 1% dividend yield. They've grown it for 1 year. Payout ratio very, very low, so very promising that they can actually grow those dividends in the near future. And again, we see that free cash flow yield at 14.4%, just fantastic. PE ratio with today's crash, 7.7, debt to equity at 0.5, so phenomenal for PayPal. SOFI, they don't pay a dividend, so therefore they haven't grown their dividend. There's no consecutive years of dividend growth. That's going to hold SOFI back in the safety category. And then Visa, dividend yield at 0.8%. They are growing their dividends fantastically, 13.5% in recent years. They have grown their dividends for 18 consecutive years with a very, very decent payout ratio for Visa. So how do these stack up? Well, no big surprise. SoFi is the least safe company of all these companies. MasterCard coming in at a 0, which is a neutral sentiment. It's not terrible, but we want something 5 or higher. American Express coming in at a 1.4, Visa tied also at a 1.4, and quite surprisingly, we see PayPal at a 7.1. So finally, we're going to look at their scores in conjunction with their intrinsic values. How do we compute intrinsic values? If you go to the description of this video, you will see 4 links that show you how to build out 4 different intrinsic value models. We've talked about those many times on this channel, so we're just going to get right into it. We're going to start with SoFi. Now, SoFi coming in with an average score of 1.05. 0 is neutral, so this is just coming in over neutral because it is a decent growth company. We were buying SoFi when it was in the single digits, when it was $7 or $8 a share. They've grown quite a bit. Now their current price is $22 per share. So we in Interflame Finance have seen great returns on SoFi. Perhaps they've done most of their growing until they can really start to ratchet this up. Average score of 1.05, intrinsically $19 per share. So we are getting a 15% premium if we were to buy SoFi today. So we're not too terribly interested in SoFi right now. MasterCard coming in with the next highest score at 1.65. Their current stock price is $551 per share. Intrinsically, we think it's $533. So basically trading for fair value, margin of safety -3%. So we're paying a 3% premium if we were to buy MasterCard today. Visa coming in, a score of 2.65, so we're getting up there. Intrinsically, we think Visa is worth $339. They're currently trading for $329, so that gives us a margin of safety of 3% for Visa. We see that their growth scores of these 3 companies is the highest, and we see that their safety scores of these 3 companies is also the highest. So what do the analysts say about these 3 companies so far? Well, we think SoFi is worth $19. The analysts think that SoFi is actually worth, on average, about $25.75. Now, the low estimate, the low analyst is coming in at $17 per share. So we're on the more bearish side of what the analysts expect. Now, SoFi is coming in at a buy rating. There are 3 strong buys, there are 3 buys, 7 hold, 2 sells, and 0 strong sells. So they're just coming into the buy area of this little gauge meter thing here. The average expectation on Wall Street is between $25 and $28. That would give you an 18 to 28% return on your money. Now, MasterCard, we think MasterCard is worth $533 per share. We look at the analyst expectations, and we are also on the more bearish side of this. As a matter of fact, the low estimate is coming in at $550. Wall Street analysts think that on average, you're going to get a 19% return on this investment in the next year. It is a strong buy, with 10 analysts saying strong, 17 saying just a regular buy, 1 saying hold, nobody saying sell, and nobody saying strong sell. Interflame Finance and Wall Street are diverging. The analysts and what we compute just don't seem to match up right now. So we're not too terribly interested in MasterCard at this point. But if this is something that you want to have in your portfolio, please let us know in the comments below. Speaking of which, if you're getting anything out of this video so far, please like this video, subscribe to the channel if you have not done so already, and feel free to tell your friends, family, and mother-in-law about the Inner Flame Finance channel. Remember, nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell anything in your personal portfolios. Always do your own research, always do your own due diligence before buying any stock. Now, next is Visa. Visa is currently trading for $2.29. We think it's worth $3.39. We are once again on the more bearish side of what analysts are expecting. Analysts are expecting about a 21% increase for Visa. They're expecting around $400 per share on average, with the high estimates coming in at $450, the low estimates coming in at $330. There are 7 analysts that think that this is a strong buy. There are 16 that say buy, 1 saying hold, nobody saying sell, nobody saying strong sell. Now, next is American Express. We think intrinsically it's $415. It's currently trading for $350. That gives us a 16% margin of safety. Well, we're on the more bullish side of what analysts expect. Analysts expect American Express to actually go down between 2 and 4% this year. The low estimate coming in at 240, meaning that would be a 31% drop in the stock price, and the high estimate coming in at 21.56%. So again, we disagree with Wall Street, we disagree with the analysts, but for different reasons. We think that of these 4 companies so far, American Express is the most attractive buy. There are 5 strong buys, 3 buys, 11 holds, 0 sells, and actually 2 strong sells for American Express stock. PayPal has the highest average score at an 8.25 and also the highest margin of safety. The current stock price is $42 per share. We think at Inner Flame Finance that it is actually worth $90 per share. And if we look at what analysts think, well, we're on the more bullish side of what analysts expect. The high coming in at $100 per share, the low coming in at $51 per share. But if you look at what analysts are expecting on average, between $74 and $76 per share, that gives us a 77 to 83% increase in the stock price over the next year. This fantastic return doesn't really seem to hold up to what analysts are saying about buying and selling. There are 4 strong buys for PayPal. There are 6 buys. There are 16 holds. There's 1 sell, and there's actually 3 strong sells for PayPal. So I'm not too terribly knowledgeable about when they update these numbers, but I would suspect that as time ticks on, if the new CEO can actually execute on what's being promised for PayPal, if they can turn this around, then I would expect to see a lot more of these strong sells turn into sells, sells turn into holds, holds turn into buys, and buys turn into strong buys. Of these 5 companies, we are mostly bullish on PayPal. As a matter of fact, there's a very good chance that tomorrow at market open, we are going to buy PayPal in our Inner Flame Finance portfolios for the very first time. So PayPal looks to be an attractive stock, especially with this gigantic dip. A lot of the risk has been taken out due to the drop in the stock price. And so if they can execute on these numbers, and if PayPal can do what's being promised, then this is a very attractive stock for our portfolios. That's the financials. That's what I have for you today. Thank you very much for watching. We appreciate you being here. If you get anything out of these videos, please like and subscribe. Tell everybody about the Inner Flame Finance methodology, and we'll see you in the next video.